The story begins in near silence, inside a cavernous factory where motion has been replaced by waiting. Robotic arms stand frozen beneath cold industrial lights, their chrome surfaces reflecting deep blues and muted golds from dormant control panels. Warning icons glow softly on layered digital screens, not flashing, not alarming, just present. The machinery is ready. The workers are ready. The designs are flawless. Yet nothing moves. Somewhere upstream, far beyond this factory floor, a single material has failed to arrive. Not lithium, not chips, silver. For decades, silver was treated as an afterthought, a background element in the modern economy. Too common to inspire fear, too valuable to ignore, yet never considered strategic in the way oil or rare earths were. That assumption shaped an entire industrial worldview. Electric vehicles, solar grids, smart weapons, satellites, data centers, all quietly absorbed silver into their cores, gram by gram, circuit by circuit. No alarms sounded as dependency deepened, no speeches warned of concentration risk. The metal simply flowed, invisible and reliable, until it didn't. In late-night offices across California, procurement teams stare at supply chain maps rendered in gold lines against darkened screens. Where there were once steady routes from Asia to North America, there are now bottlenecks marked in amber. China. The flow narrows there. Export approvals slow. Paperwork lingers. Classifications change. Officially, nothing dramatic has happened. There is no public embargo, no headline declaration of economic warfare. Yet containers that once crossed oceans without friction now sit in ports, waiting for permissions that may never come. Silver is no longer just silver. It is a policy instrument. China understands this better than anyone. Over the past 3 decades, it did not merely mine silver, it absorbed the entire value chain. Ore extraction, refining, alloying, component manufacturing, each layer pulled inward, subsidized, protected, integrated. Western economies, chasing efficiency and environmental distance, let these stages drift overseas. Refining was dirty, margins were thin. Better to innovate at the top of the chain and let someone else handle the metal. That decision now echoes through every stalled production line. Inside Beijing, the atmosphere is controlled, almost ceremonial. Conference rooms glow with warm yellow light reflected off polished tables. Charts are not dramatic, they are precise. Export volumes, strategic allocations, downstream demand projections. Silver appears not as a commodity, but as a lever. By adjusting licensing frameworks and regulatory scrutiny, flows can be shaped without ever being cut. The brilliance lies in subtlety. Markets struggle to price what cannot be clearly seen. Across the Pacific, Tesla's factories feel the consequences immediately. Electric vehicles are silver-intensive by design. Power electronics, battery management systems, inverters, charging interfaces all rely on silver's unmatched conductivity and durability. There are alternatives, but they compromise efficiency, safety, or longevity. In engineering rooms lit by cool blue screens, teams debate microscopic design changes, shaving fractions of grams from each unit. The math is unforgiving. When millions of vehicles are planned, even tiny shortages become existential. Financial dashboards begin to flicker. Procurement costs rise quietly at first, buried in broader inflation narratives. Then delivery schedules slip. Investors ask questions on earnings calls. Executives respond carefully, avoiding the word China, speaking instead of global supply adjustments. But behind the language, urgency builds. Every idle hour inside a gigafactory burns capital. Every delay ripples outward. Suppliers, logistics firms, dealerships, charging infrastructure. Silver's absence multiplies through the system. The camera drifts through offshore financial centers where the real drama unfolds, far from factory floors. In Singapore, traders monitor futures curves that bend sharply upward, their screens casting amber reflections onto glass walls. In Zurich, vaults hum beneath thick stone, holding allocated silver owned by funds whose beneficiaries remain hidden behind layers of trusts and shell companies. Scarcity is monetized here long before it reaches consumers. Those positioned early profit quietly, protected by jurisdictions designed for discretion. This is how modern power operates, not through visible confrontation, but through control of choke points buried deep inside complex systems. China does not need to announce dominance, it simply allows the world to feel it. Each delayed shipment forces manufacturers into a choice: pay more, wait longer, or redesign the future around constraints set elsewhere. None of these options favor speed or independence. In Washington, speeches echo through marble halls about resilience and reshoring. Plans are announced, incentives proposed, maps of potential mining projects glow on presentation screens in patriotic hues. But the timeline betrays the ambition. Mines take years to permit, refineries take longer to build, skilled labor must be trained, environmental reviews must be survived. Markets, meanwhile, move daily. China's advantage compounds, while responses remain theoretical. The deeper truth is uncomfortable. The United States did not lose control of silver overnight. It surrendered it gradually, transaction by transaction, efficiency by efficiency. The system rewarded short-term cost savings and punished redundancy. Strategic stockpiles were deemed unnecessary in a world of free trade. Just-in-time logistics were celebrated as brilliance rather than risk. Now, the bill arrives with interest. As night settles over an American factory, emergency lighting casts long shadows across silent machines. The atmosphere feels less like a workplace and more like a vault, sealed, waiting, constrained. Somewhere inside a battery pack design, a missing silver connection prevents an entire vehicle from existing. Scale magnifies fragility. The future stalls, not because ideas are lacking, but because atoms are absent. China's position grows stronger precisely because it remains understated. Official statements emphasize environmental protection, domestic demand, national security. Each justification is defensible on paper. Together, they form a wall no single trade complaint can breach. Allies feel the pressure too, but quietly. Japan negotiates, Europe hedges, everyone adapts. America, visible and vocal, finds adaptation harder. The story does not end here. It pauses, suspended between recognition and response. Silver has revealed a deeper architecture of power, one where control of materials outweighs control of narratives, where hidden systems decide visible outcomes. As the screen fades into deep blue and gold, a final image lingers. A microscopic silver pathway etched into a circuit board, glowing faintly under magnification. Small enough to ignore, powerful enough to stop the future cold. The second movement begins far from factory floors, in places designed never to appear on camera. Windowless rooms hum with controlled air, their walls lined with screens that do not display prices but permissions. In these spaces, trade is not negotiated in open markets, but filtered through regulatory layers so dense they resemble encryption. Silver does not move because buyers want it, it moves because it is allowed to. And increasingly, allowance has become conditional. On paper, China has not banned silver exports. The distinction matters. A ban invites retaliation. A restriction invites confusion. Export licenses are reviewed more slowly, environmental compliance standards tighten, end-use declarations grow more detailed. Each change is defensible, technical, procedural. Together, they slow the bloodstream of global manufacturing without triggering the immune response of global trade law. Containers leave ports half full, contracts remain unsigned, timelines stretch just enough to cause damage, never enough to provoke a clean counterstrike. This is how leverage is exercised in a financialized world. Power hides inside bureaucracy. The camera drifts through a Chinese refinery where molten metal flows in controlled channels, glowing pale gold under low light. Unlike mines, which are visible and political, refineries are quiet instruments of dominance. Whoever controls refining controls purity, form, and timing.
Silver ore is abundant in many countries, but refining capacity is not. China spent decades expanding this capacity while others dismantled theirs. Subsidies softened losses, environmental costs were absorbed. The long game was patience. Now that patience pays compound interest. Western manufacturers once believed that owning designs meant owning destiny. But designs are abstractions. They only become reality when fed by materials shaped to exact specifications. Tesla's blueprints are useless without silver refined to precise tolerances, delivered at precise moments. In procurement rooms lit by cool, dim light, sourcing teams scroll through supplier databases that once offered redundancy. Today, those lists look ornamental. Alternative suppliers quote prices that defy budgets or offer volumes too small to matter. Some refuse outright, citing their own contractual obligations upstream. The market reacts before policymakers do. Futures curves on Asian exchanges bend sharply upward, their movement subtle but relentless. Offshore funds operating through shell companies in jurisdictions designed for silence position themselves early. They do not care who builds cars or solar panels, they care about scarcity. And scarcity, when engineered, is the most reliable asset of all. Silver becomes less a metal and more a narrative, a story of inevitability that markets are quick to believe. Inside Tesla, contingency plans unfold in stages. First, inventory buffers are drawn down. Then, production targets are quietly revised. Then, capital expenditures are delayed, masked as strategic prudence. Each step is rational in isolation. Together, they signal constraint. Analysts notice, questions sharpen, language on earnings calls grows careful, abstract. The word silver is rarely spoken. It does not need to be. Those who understand supply chains already see it. Beyond Tesla, the ripple spreads. Defense contractors feel it. Renewable energy firms feel it. Data center builders feel it. Silver threads through systems designed for national security and economic transition alike. That dual-use nature is precisely why it matters. By controlling a material that serves both civilian and military ends, China exerts influence without drawing lines between peace and conflict. Everything becomes strategic by default. The imagery darkens as the story moves offshore. In London, trading desks operate behind tinted glass, screens reflecting gold and blue across tired faces. In Dubai, private meetings unfold in hotel suites overlooking the desert, where intermediaries promise access at a price. Each deal adds another layer between source and user, another margin captured by those closest to the choke point. The metal grows more expensive without ever becoming scarce in absolute terms. Scarcity is relative. It exists wherever timing fails. American policymakers push for reshoring, but the contradiction is stark. Building domestic refining requires silver to begin with. The chicken and egg problem is brutal. To escape dependence, you need access to the very resource being restricted. Strategic stockpiles are proposed, but acquiring them in a tight market only accelerates price inflation, enriching the same hidden players who benefit from constraint. Every move feels reactive, one step behind a strategy that began decades earlier. China's messaging remains calm, almost benevolent. Official statements emphasize sustainability, domestic demand, responsible trade. There is no gloating, no triumph. Dominance does not require volume when it has position. By the time Western governments debate countermeasures, supply chains have already adapted around new realities. Manufacturers redesign products to use less silver. Performance suffers. Costs rise. Consumers notice only at the margins, unaware of the deeper trade-offs being made on their behalf. The imagery lingers on spreadsheets that stretch endlessly, numbers cascading downward in pale light. Margins compress, forecasts blur. Risk models adjust assumptions that once felt permanent. Just-in-time logistics, once praised as genius, now appear brittle. There is no slack left to absorb shocks. The system was optimized for efficiency, not for resilience. China's model, often criticized for redundancy and state intervention, suddenly looks prescient. Behind the scenes, alliances shift. Some countries secure preferential access through quiet diplomacy. Others are left waiting. The global order fragments, not through war, but through allocation. Who gets silver this quarter? Who waits until next? These decisions reshape industrial capacity more effectively than tariffs ever could. The world does not split into blocks overnight. It slides into them gradually, almost politely. As the second movement nears its end, the sense of inevitability deepens. This is not a crisis that peaks and fades. It is a structural reordering of power, written in export licenses and refining capacity, rather than treaties. Silver has become a language spoken fluently in Beijing and only haltingly elsewhere. The final images hover between motion and stillness. A refinery pours metal without pause. A factory thousands of miles away waits in silence. Between them lies a system designed to appear neutral, technical, apolitical. Yet every delay carries intent. Every permission carries leverage. And as the screen darkens into deep blue, the question sharpens rather than resolves. If silver can be controlled this quietly, how many other materials are already shaping the future beyond public sight?
The third movement widens the lens, pulling back from the immediacy of stalled factories to reveal a longer pattern, one etched into history and repeated whenever empires shift. Control over materials has always preceded control over markets. Coal fueled Britain's rise, oil underwrote America's century, and now metals, quiet, technical, indispensable, form the backbone of modern power. Silver's return to prominence feels less like a surprise and more like a correction, a reminder that beneath algorithms and platforms, the physical world still decides what is possible. Archival imagery fades in with warm, desaturated tones. Ancient coins dissolve into early circuit boards. Vaults give way to server farms. The symbolism is unmistakable. Silver once anchored monetary trust itself. Today, it anchors technological trust. Every data packet, every electric current, every autonomous decision flows through pathways that depend on this metal's unique properties: conductivity, reliability, resistance to corrosion, traits that cannot be replicated cheaply or at scale. The world built its future on silver without ever securing it. China's strategy aligns seamlessly with this historical logic. While Western economies celebrated financialization, offshoring, and service dominance, China absorbed the material layers others discarded. It accepted environmental costs, thin margins, and geopolitical suspicion in exchange for something far more durable: position. Refining capacity expanded quietly. State-backed firms acquired stakes in foreign mines. Logistics networks grew dense and redundant. By the time the green transition accelerated, the infrastructure to feed it was already concentrated. The camera moves through dim corridors of Chinese state enterprises, where walls are lined with framed maps and production targets rather than motivational slogans. The atmosphere is patient, long-term, insulated from quarterly panic. Silver is discussed alongside copper, lithium, and rare earths, not as separate commodities but as an ecosystem. Each reinforces the other. Control one, and you influence the flow of all. The elegance lies in integration. No single node appears decisive, yet together they form a web difficult to escape. In contrast, American industry confronts its own reflection. The logic that drove outsourcing now exposes vulnerability. Refining was outsourced because it was messy, regulated, and politically inconvenient. Mines were delayed because communities resisted and capital demanded fast returns. Stock buybacks outpaced investment in physical resilience. These decisions were rational within the system that rewarded them, but systems revealed their flaws only under stress. Silver has become that stress test. Inside research labs, engineers chase material efficiency with almost obsessive precision. New alloys are tested under magnification, coatings are adjusted, designs are reimagined to reduce silver load per unit. Progress is real but incremental. Physics does not bend easily to urgency. Each workaround introduces trade-offs: higher heat, lower durability, increased failure risk. The future becomes slightly less robust with each compromise, even as headlines continue to promise progress. The financial layer tells its own story. Institutional investors reposition portfolios away from manufacturers toward upstream material plays. Hedge funds that once ignored silver now model it obsessively, treating it as both industrial input and geopolitical signal. Volatility becomes opportunity. Offshore structures bloom again, channeling profits through jurisdictions optimized for opacity. Wealth accumulates not where things are built, but where constraints are controlled. This inversion is subtle but profound. In Washington, strategic discussions grow more candid. The language shifts from efficiency to security, from cost to resilience. Yet translating intent into infrastructure remains slow. Building domestic refining capacity requires bipartisan consensus, environmental compromise, and patient capital. None are abundant. Meanwhile, China's system continues to operate without visible strain, its decisions cushioned by state support and long planning horizons. The camera tightens around contrasts. A Chinese refinery operates continuously, molten silver flowing like a controlled river under soft yellow light. An American factory pauses, machines dimmed, blue shadows stretching across polished floors. Both are technically impressive, only one is moving. Power in this context is not innovation alone, but continuity. Historically, such imbalances do not resolve quickly. They persist until new structures emerge or old ones collapse. The world is entering that interlude now. Silver shortages do not make headlines like oil shocks, but their impact is cumulative, structural, and difficult to reverse. Each delayed project compounds the next. Each compromised design lowers the ceiling of what can be built. China's export controls, still framed as regulatory refinement, harden into expectation. Manufacturers begin planning around them as a permanent feature. Supply chains reroute not to escape China entirely, but to accommodate its terms. Dependency shifts from implicit to explicit. This is how dominance normalizes itself, by becoming the baseline assumption rather than the exception. The camera glides over financial models projecting a decade into the future. Scenarios branch and converge, most assuming continued Chinese control over critical materials. In these models, American manufacturing survives, but at higher cost, lower speed, and reduced strategic autonomy. The difference is not collapse, but constraint. A future where choices narrow gradually, almost imperceptibly. As the third movement approaches its close, the tone grows contemplative. This moment is not yet a crisis in the dramatic sense, it's a hinge. The decisions made now, whether to invest, adapt, or accept, will determine who shapes the next industrial era. Silver has illuminated the stakes with unforgiving clarity. The final images linger on a simple contrast. A polished silver coin rests beside a modern circuit, both catching the same muted gold light. Centuries apart, they share a function, enabling systems of trust and exchange. One underwrote empires of the past, the other underwrites the future. As the screen darkens, the realization settles quietly but firmly. Control of materials has always been control of destiny, and silver has returned to remind the world of that truth.
The final movement opens in a space filled with ambition and unease. Architectural renderings glow across wide screens, showing new mines etched into desert landscapes, refineries rising from industrial zones, supply routes traced in confident lines of gold and blue. These images represent intent, not reality. They are promises projected into a future that cannot arrive fast enough. On the ground, the present remains defined by constraint. In the United States, policy has finally caught up to the problem, at least rhetorically. Strategic autonomy replaces efficiency as the guiding principle. Incentives are drafted, subsidies announced, timelines compressed on paper. Yet beneath the optimism lies a brutal arithmetic. Mining permits take years, refineries take longer, skilled metallurgists are scarce, environmental resistance is real. Capital demands certainty in a world that now feels anything but certain. Even with urgency, the clock refuses to accelerate. China, meanwhile, does not need to rush. Its advantage compounds simply by existing. Every month of delay elsewhere reinforces its position. Export controls remain selective, adjustable, deniable. Licenses are granted or withheld in patterns that reward alignment and punish unpredictability. The system does not seek collapse, it seeks dependence. Stability under its terms is far more valuable than disruption. Inside Tesla's factories, the response has shifted from shock to adaptation. Production lines resume, but not at full speed. Designs evolve to minimize silver usage. Procurement teams accept higher prices as the cost of continuity. Margins thin, ambitions are revised quietly. None of this appears in marketing campaigns or keynote presentations. The public narrative remains of progress and inevitability. Behind the scenes, resilience is being rationed. The camera moves through the hidden layers of finance where this adaptation is priced and traded. In New York, risk models incorporate new assumptions about material access. In Hong Kong, traders exploit timing gaps between policy signals and market reactions. In offshore centers, wealth accumulates in silence, sheltered from scrutiny by legal structures perfected over decades. These flows do not build cars or power grids, but they shape who can afford to. What emerges is a new hierarchy, not announced, but felt. Nations with material control set the tempo, others adjust. The green transition, once framed as a universal opportunity, becomes uneven. Those who control silver accelerate, those who do not compromise. The planet may still electrify, but the distribution of benefits shifts. Technology spreads, but sovereignty does not. The deeper implication extends beyond silver. The world begins to reassess every critical input through the same lens. Copper, nickel, graphite, rare earths. Each reveals similar patterns of concentration and control. Silver was simply the first to expose the system at scale. It becomes the case study policymakers cite in closed meetings, the example analysts reference when discussing hidden risk. Its lesson is uncomfortable but clear. The future is built not only on ideas, but on who owns the means to realize them. Visually, the tone darkens again. Confidential documents slide across tables. Digital ledgers scroll endlessly. Warning symbols appear and vanish on screens. None of this is meant for public view. This is the backstage of global progress, where decisions are technical, language is neutral, and consequences are enormous. Power wears the disguise of procedure. China's long game becomes fully visible here. By embedding itself at multiple layers of the value chain, it reduces vulnerability while increasing leverage. If one material faces scrutiny, another fills the gap. If one export draws attention, another becomes the focus. The system is flexible, resilient, and largely immune to external pressure. It does not require dominance everywhere, only dominance at key junctions. American responses grow more sophisticated, but also more constrained. Partnerships with allies deepen, joint ventures are announced. Yet each collaboration must navigate the same obstacles: cost, time, politics. The market, impatient and unforgiving, prices these delays immediately. Share prices fluctuate, capital reallocates. The invisible hand, often celebrated, now feels indifferent. As the narrative approaches its end, the question shifts from blame to consequence. What does a world look like where technological leadership is decoupled from material control? Innovation continues, but within boundaries set elsewhere. Manufacturing persists, but under negotiated conditions. The language of competition softens into the language of accommodation. This is not defeat, it is adjustment. But adjustment carries a price. The final image is slow, becoming almost still. A single silver filament glows inside a circuit, magnified until it fills the frame. Around it, data streams fade, factory noise recedes, and the broader system dissolves into abstraction. The focus narrows to the material itself, simple, conductive, ancient. So small it can be overlooked, so essential it can halt entire industries. The documentary does not end with resolution or reassurance, it ends with recognition. Tesla's struggle to secure silver is not an isolated supply chain problem. It is a signal flare from a deeper shift in global power. Control has moved downward into layers most people never see. Those layers now decide speed, scale, and sovereignty. As the screen fades to deep blue and muted gold, one truth remains illuminated. The future will belong not just to those who imagine it, but to those who control the materials that make imagination real.